Welcome to the Battlefield Trading YouTube channel. Have you ever wondered if there's a tool that can bring more clarity to stock market trends and provide powerful trading signals? Introducing Heikin Ashi candles, a powerful tool in financial trading. Heikin Ashi candles are not just another type of candlestick chart. They offer a unique approach to understanding market trends and spotting trading opportunities. Compared to traditional Japanese candlesticks, Heikin Ashi candles are specifically designed to smooth out price fluctuations, making it much easier to identify trends. In this video, we'll cover everything you need to know about Heikin Ashi candles, what Heikin Ashi candles are, how to read Heikin Ashi charts, 5 key Heikin Ashi signals, how to apply Heikin Ashi in stock trading. Let's dive in and explore how you can use Heikin Ashi to upgrade your trading strategy and make smarter decisions in the stock market. We'll get started right after the intro.
Warning.
Let's begin with the question. What exactly are Heikin Ashi candles? The term Heikin Ashi comes from Japanese and literally means average bar. Unlike traditional Japanese candlesticks, Heikin Ashi uses the concept of averaging to create a smoother chart, making it easier to spot trends and potential reversals in the market. The close of a Heikin Ashi candle is calculated by taking the average of the current candle's open, high, low, and close, then dividing that sum by 4. The open of a Heikin Ashi candle is placed at the midpoint of the previous candle's body. Thanks to this smoothing mechanism and its ability to reveal clearer trend direction, Heikin Ashi is a powerful tool for traders looking to optimize their strategies in the stock market. Here's an example. On a traditional candlestick chart, you'll often see green and red candles scattered in a choppy, unstructured way. It can be hard to make sense of the trend. But when we switch to a Heikin Ashi chart using the exact same price data, the price behavior becomes much more organized. We see a series of green candles representing an uptrend and a sequence of red candles indicating a downtrend. If you're finding this content helpful, make sure to hit the like button and subscribe to our channel so you never miss our latest videos. Next, let's move on to part 2, how to read Heikin Ashi candles. Reading Heikin Ashi charts is actually quite simple and straightforward. On a Heikin Ashi chart, we primarily deal with 3 types of candles. 1. Bullish candle. This is a green candle with a large body and an upper wick. It typically has little to no lower wick. Such candles indicate that the price is in an uptrend. 2. Bearish candle. This is a red candle with a large body and a lower wick. It usually has a small or no upper wick. These candles are a strong sign of a downtrend. 3. Doji candle. A doji candle can appear in either green or red. Its key characteristic is a small body with long wicks on both ends. The upper and lower wicks are almost equal in length. This type of candle suggests that the current trend is weakening and that the market may be entering a consolidation phase. We use these 3 types of candles to identify 5 key signals on the Heikin Ashi chart. Signal number 1, strong uptrend. In a strong uptrend, we typically see a series of bullish green candles with no lower wicks. Each candle's body gets progressively larger, indicating increasing bullish momentum. This is often a great time to enter long buy positions. Signal 2, weak uptrend. As the uptrend starts to weaken, the bodies of the green candles begin to shrink. Occasionally, we may also see the appearance of lower wicks. This suggests that the bullish momentum is fading, and the market may be entering consolidation or even preparing for a trend reversal. If you're already holding a long position, this would be a good signal to consider closing your trade. Signal number 3, sideways trend. After a strong trending move, we may begin to see a cluster of doji candles. A single doji candle can signal a loss of momentum. But when several dojis appear in succession, it clearly indicates that the market has entered a sideways or ranging phase. Signal number 4, strong downtrend. A strong downtrend is identified by a series of bearish red candles with no upper wicks. Each candle has a larger body than the previous one, showing that bearish momentum is accelerating. This presents an excellent opportunity to initiate short sell positions. Signal number 5, weak downtrend. When the downtrend loses strength, we begin to see a series of red candles with upper wicks forming. At the same time, the candle bodies become smaller and smaller. This is a classic sign that bearish momentum is weakening, and the market may be headed for a pause or a potential reversal. Before we move on, if you're finding this video helpful, don't forget to hit the like button and subscribe to the channel to support our work. And feel free to leave a comment below if you have any questions, feedback, or suggestions for future topics you'd like us to cover. Now let's look at some examples that combine these signals with other price action elements to build trade ideas. On this chart, we can see that the price reversed from this area before, so we mark it as a support level. When price returns to this support zone, we can expect a possible bullish reversal. As the price approaches this level again, we need to look closely at the candles forming during the pullback. First, we see a series of red candles with no upper wicks, but the candle bodies are not getting bigger. In fact, they're getting smaller. That tells us the down move is not strong. Next, we see a red candle with a small upper wick, another sign of weak selling pressure. Then we get two doji candles with long upper and lower wicks. And importantly, these appear right at the support level. This shows that the support is holding well, and there's a high probability of an upward move from here. Finally, we get a strong green candle with a large body and no lower wick. That's a clear bullish signal. So this is a good spot to place a buy trade. You can set your stop loss just below this candle and place your take profit at the next resistance level. Here's an example of a sell setup. We can see that price previously reversed from this area, so we mark it as a resistance level. Now, as the price returns to that resistance, we expect a potential reversal to the downside. As price approaches this level, we notice the candle bodies begin to shrink, a clear sign that bullish momentum is fading. Then, we see a doji candle with long upper and lower wicks. Again, this signals that the uptrend is losing strength. Finally, we get a strong red candle with a large body and no upper wick. This confirms that the resistance is holding and the price is likely to drop from here. So we can place a sell trade at the close of this red candle, set the stop loss above the candle's high, and target the next support level as our take profit zone. Here's an example of a breakout trade using Heikin Ashi candles. In this case, we see that the price previously bounced upward from this area, so we mark it as a support level. Now, as the price returns to this zone, we expect it might find support again and bounce back up. But instead, we start to see small doji candles forming. This tells us that price is moving sideways in a tight range, and the support level is losing strength. Next, we see two strong red candles that break below the support. This is a clear sign of a powerful breakout, and we can expect a sharp downward move. So, we can enter a sell position on this red candle, set the stop loss just above the candle, and place the take profit at the next nearest support zone. Here's a trade setup using a moving average. We have a 20-period moving average on the chart. Price is trading above the moving average, and the MA is sloping upward, which confirms an uptrend. We can also see that the moving average has acted as support during previous pullbacks. This time, when price pulls back to the moving average, we expect it to find support again, just like before. Plus, we also have a horizontal support from a previous high. So now we have a confluence of the moving average and a price support level in the same area. Here, we see two doji candles, which indicate that bearish momentum is extremely weak and price is likely to find support at the moving average. Then we get two green candles that seem to confirm our expectation. This gives us a solid buy opportunity. So we enter a buy trade at the close of this green candle. We can set the stop loss just below the candle or below the moving average. In this trade, we don't have a clear resistance level to target, so we can aim for a 1-2 risk-to-reward ratio as our take profit. And that's how you use Heikin Ashi candles in your trading. Remember, success in trading comes from combining multiple factors, not just one signal.